Australia's peak superannuation body believes the risks contained within the rapidly growing self-managed superannuation sector have the potential to threaten the whole economy. The Association of Superannuation Funds of Australia says it's a real concern that the issues surrounding DIY super were not addressed by the Cooper Review. Andrew Robertson reports.
As leaders of the superannuation industry gathered in Sydney, the man who conducted the government's review of their sector was there to listen. But the Association of Superannuation Funds of Australia is concerned that the Cooper Review's focus was primarily on the large regulated funds and not self-managed super.
There is 1.1 trillion. 2/3 are regulated, 1/3 is not regulated, and we must make sure that the levers across the whole of the 1.1 trillion drive those public policy outcomes.
Self-managed superannuation is now the biggest segment of the super industry. There are nearly 500,000 funds with a total balance of just under $400 billion. Pauline Varmos says because of its size, the risks involved with self-managed super now have implications for the whole economy.
If you've got that level of risk being borne by people who now manage 1/3 of the retirement income system, do we have a risk here that is tolerable?
The risks around self-managed super have been highlighted again in the collapse of Trio Capital, where there are now calls for a compensation fund to be established along the lines of the one already in existence for big regulated funds. Pauline Varmos, who represents those big funds, thinks a better way of providing a safety net, though, for self-managed super is to compel them to take a different approach to investing.
I think one of the ways we can get a safety net is either start looking at a minimum before you move into a self-managed fund. Another way is to look at mandatory diversification, and it might be 2, 3 or 4. So if one of the assets fall or one of the product providers fall, there is some sort of safety net there.
Housing is a key asset in many self-managed superannuation funds, and the Ask for Lunch heard a warning about the dangers contained in Australia's currently overheated housing market. John Coombe from Yana Investment Advisors believes the market should be given time to naturally correct itself.
If we muck around with it, or if policymakers muck around in the market, we could cause a big problem for our banking sector and therefore our economy. We are very fortunate that we haven't pricked that bubble to any extent and caused problems within the domestic economy.
And while housing prices remain inflated, many believe the US stock market is heading the same way, with the Dow Jones index rising 10% in the last year. American investment analyst David Marvin believes the market will continue its surge as more people who bailed out of shares during the global financial crisis begin looking again for higher returns.
I think they'll be returning because the two alternatives that most people have, which are cash/bonds, are unattractive. Cash pays nothing. Bonds are so cheap relative to any type of reasonable expectations that there's no reason people would want to put additional money into bonds.
Whether David Marvin's view turns out to be right may well depend on the fledgling US economic recovery gaining real momentum in coming months.